Hello everyone, welcome to today's video. Today we are going to learn the most important ratios which are being widely used by the investors and traders while doing the fundamental analysis of any stock. I am planning to do a series of videos on these important ratios which I think could help somebody who is relatively new to the market and trying to understand the market. In today's video, we are going to cover two such ratios which are widely used by the investors. One is PE ratio, that is called as price to earning ratio, and the second one is the EPS, that is earning per share. I have taken both this together because both are connected in a way that in order to calculate a PE of any stock, you need the value of EPS, that is earning per share. Request you to watch the video till the end because I am going to give some of the examples so that will make you easier to understand this and you can easily interpret the value of PE or EPS of any stock in a right way. Let's start with the first ratio, that is earning per share. If you go with the formula, it's earning per share is nothing but the net profit of a company divided by the total number of shares that has been issued by the company. The net profit, you will get it from the annual report or from the quarterly report of a company, and the total number of outstanding shares or the number of shares that has been issued by the company, you will get this data from the balance sheet. Let's calculate this with an example. Let's consider there is a company called as A. It has a total shares of 200 and it has a net profit reported 1000. So if you calculate EPS, it will come to 5 rupees per share, that is 1000 divided by 200, that comes to 5 rupees. So if you had one share of this company A, then you have earned 5 rupees for your one share. Now let's come to our important ratio, that is called as price to earning ratio, that is PE ratio. This is one of the widely used ratio. At the same time, a lot of us tend to misinterpret this ratio. Now let's consider the same example of company A, and we know that the EPS, earning per share of company A, is 5 rupees, and let's assume that the share price of the company is currently trading at 100 rupees. Now let's calculate the PE of company A. The formula is simple, share price divided by EPS. So I told you share price is 100 rupees and EPS is 5 rupees, that comes to 20. So the company A has a PE value of 20. Now what you make out of this number 20? It's simple. If you are buying one share of company A, that means you are ready to pay 100 rupees to earn 5 rupees annually. In simple terms, you are paying 20 times of its earning. Now you have the value of we have the P value of company A. Now can you tell me whether this stock is overvalued or undervalued? No. The P value of any company does not tell you anything in isolation. It has to be compared with its industry peers. Now let's take another example of company B, and let's assume that company B belongs to the same industry as company A and company B is of the same scale as company A. Now let's say the EPS of company B is 5 rupees and company B is currently trading at 50 rupees. Now if you calculate the PE for company B, it comes to 50 divided by 5, that comes to 10. Now we know that company B has a PE value of 10 and company A has a P value of 20, and both companies belong to same industry and of the same scale, and more or less both of them are of the same characteristics. Okay, now if you go with the maths and the general assumption, company B is less expensive compared to company A. Now tell me, will you make your investment decision only based on the PE value? Just because company B has a less PE, will you invest all your money in company B? It's all about interpretation of the PE. Investor A will think differently from investor B. Every investor has their own style of investing and every investor has a different interpretation of PE. Now I will put some more data of company A and company B on your screen. You can see the earnings per share of the company A and company B for the last 3 years. If you see, company A's earnings have grown much faster than company B. If you see for company A, the EPS has been grown from 2 rupees to 3 rupees for year 2019-20. That is almost 50% jump. For year 2021, again the EPS has been grown from 3 rupees to 5 rupees. That is almost 66% jump in EPS. The company with such earnings, it's very obvious that it will attract more and more investors who believe in growth investing. In the case of company A, the high PE is justified by its numbers and you can interpret that investors have high expectations for future earnings growth of this company and ready to pay more today for the future earning. In case of company B, I'm not saying the company B is bad because they are also growing at the rate of around 12%, but they're not able to match up with the company A in terms of earnings growth. I don't consider a company as bad unless there is a continuous degrowth in their earnings, and the same thing, when it reflects in their share prices. Company B may not have that operational excellence in order to generate a profit as company A does. A conservative investor can consider buying company B given its attractive valuation and if there are a lot of growth potential in this sector, and also assuming that company will do good in the future in terms of earnings. Market is ready to give such a premium valuation to company A because of its earnings. More and more people start buying company A. As a result, the PE of the company will also increase because we know by the formula of PE that price to earning ratio is directly proportional to the share price of the stock. Now one might argue that along with the share price, the EPS is also growing. Okay, if you go by the formula, the PE is inversely proportional to EPS. That means if EPS increases, PE should decrease. Yes, your argument is right, but in the case of growth stocks, their strong earnings attracts more and more investors. So their share price increases much faster than their EPS. So in the case of growth stocks, the share price is the one which drives the PE value. Now let's see some of the downsides of EPS and PE. The high PE stocks of the companies always be under pressure to do more in order to justify their valuation. Suppose in future if they have failed to perform, then your investment will be under risk because you have already paid more when you are buying those stocks. Sometimes you might end up misreading the EPS value. You see that EPS has been increased, but you fail to notice that this increase in EPS, it's not because of increase in their net profit. There are a lot of other factors that could contribute to increase in EPS without increase in their net profit. There is something called as share buyback. In this process, what companies does is they repurchases the shares from their shareholders by settling their money. So in this case, those repurchased shares will be treated as cancelled. As a result, the total number of outstanding shares of a company will be reduced. So in this scenario, companies' EPS can be increased even if there is no increase in their net profit because there is a reduction in their total number of shares. Now let's see the limitations of PE as well. When you're investing in cyclical stocks, the PE value may not work very well because the earnings of cyclical stocks fluctuate too much to make a PE as a very meaningful ratio. The examples of cyclical stocks may be hotels, restaurant, tourism stocks, commodities like steels, automobiles, and also real estate for that matter. Their earnings mainly depend on economic conditions. When economy is favorable, their earnings will rise very sharply, so they tend to have a very volatile EPS. There are some other ratios will be used to assess these kind of stocks. I'll make a separate video on this. I'll put a screenshot of a cyclical stock on your screen. So that will demonstrate how a low PE of a cyclical stock can be proved wrong. There was a cyclical stock that was trading at 576 rupees in the month of September 2010 with a PE of 27 and EPS of 20 rupees. If you see the very next month in October 2010, the EPS has been increased to 65, almost threefold jump, and PE reduced to 9.6, and the stock price is 596. There is not much increase in the share price. A new investor might jump into buying this stock assuming that their earnings have been grown very drastically and PE is also very attractive and he thinks he is picking a very value stock. Now let's see what happens with stock immediately after this. The stock started its downtrend from 2010 till 2013. The stock price reached 208 from 596. Imagine the investor who would have entered in 2010 and had to wait till 3 years for stock to rebound. That's what an investor must consider lots of other factors before deciding investing in any cyclical stocks like economic conditions and cycles of these stocks, etc. I can make a separate video on this if I get a lot of comments and likes in this video. It's time to conclude today's video. If you like the content, please press the like button and subscribe to my channel. I will see you all in the next video. Thank you.